So let's talk about company ownership schemes. Plans, schemes, whatever you want to call it, right? It's just a word. So there's a number of different schemes or plans that exist. Right? So we start thinking about those different plans. One is it's a pretty simple one. It's an employee stock purchase plan. Usually these are going to be separate plans. Because we're issuing stock, there is a filing that has to be made with the Securities and Exchange Commission, the SEC. And these are generally going to be a specific type of filing. So now you're familiar with some public filings. You're familiar with 10Ks, 10Qs. Maybe you're familiar with 8Ks. Maybe you should be familiar with S3s and S4s. And if you're not, bring it up in class. We can talk about what each of these things mean. Because these are all SEC filings. And there's a number of other filings that exist as well. But those are some of the big ones. And one of the big ones is what's referred to as an S8. And it's related to these types of stock purchase plans where we are allowing employees to buy stock at a bit of a reduced rate. But we have to file this S8. Why do we have to file this S8? Because existing owners want to know what we're doing. They want to know, hey, by the way, we're going to issue some more shares, and that's going to dilute your ownership percentage. These are brand new shares, so maybe you owned 5%. Well, I'm going to issue a whole bunch of shares to employees or allow them to buy it. And your 5% might now only be worth 4.9% or maybe less, depending on how many shares I issue. So these filings are for the existing owners to understand what you're doing with their ownership structure and their ownership percentage in the organization. Because every time you issue a new share, the existing owners now have less influence because now the denominator in the equation is bigger. Always a good question to ask in class if you haven't really thought through what some of these things are. So we've got employee stock purchase plans. We could award employees, whereas the employees here are buying the shares, we could award the employees shares with restrictions. And I want those restrictions in place, right? I can't even spell employees. Come on, Charlie. We want those restrictions in place because these restrictions are likely related to you don't actually get to you got the shares, but it's going to stay restricted until you've done what we want you to do, right? So until you have really earned them. And that might be due to market conditions, performance conditions, or service conditions. Service conditions, well, you have to work here 4 more years before these become unrestricted. Or you have to grow the company's sales to X billions of dollars or millions of dollars before these become unrestricted. Or the stock price has to hit a certain level before these shares become unrestricted. So we want to look at, because this is going to help us understand how to recognize expense when we give employees shares. Because if we think about giving something to the employees, well, if I gave them cash, it's an expense. If I give them shares, it's also an expense. Whereas the employee stock purchase plan could potentially be written such that it's not compensation expense. We'll talk a little bit more about what makes it non-compensatory for an employee stock purchase plan versus compensatory. So I can award employees shares with restrictions, or I can give the employees, I can award, whoops, wrong color, sorry about that. I can award the employees options to purchase shares. Again, market performance and service conditions also would apply here. And that's going to dictate whether or not, or not whether, how we recognize compensation expense associated with these options. Now, with these option plans, it's very interesting. Some of these are going to be from the IRS's perspective, right? So we're looking at the IRS. Oops, can't even spell it. IRS, not ISR. IRS, right? The IRS's perspective. Some of these plans are going to be taxable to the employee. So they're going to be taxable to the employee. And other plans may be non-taxable. So we could have a taxable plan, also referred to as a non-qualified plan. Or it could be non-taxable to the employee. Those are going to be, this is non-qualified. That's right, you guessed it. This is a qualified plan. And if it's taxable to the employee, then guess what? It's deductible for the company. It's a deductible expense for the company. It's still going to be an expense on the financial statements, but now it's a tax deductible expense. If it's non-taxable to the employee, guess what? It's also it's non-deductible for the company. So it's a balancing act, right? So we're going to give out the shares or the option to purchase these shares. What do you think the employee would rather have? Well, they would rather have the non-taxable one, and so therefore I don't get a deduction. But if I'm going to give the shares out, maybe I want the tax deduction, and I don't really care that the employee also has to pay taxes on it. So these are decisions that you have to make as a company. And then the accounting is different. Because if we're dealing with a non-taxable or qualified plan, then the expense, when we go back to accounting for income taxes, the expense of a qualified plan becomes a permanent difference in our rate and our taxable rate reconciliation. If it's a non-qualified plan, we don't get to take the deduction until the employee exercises the option. So then this becomes a deferred tax asset. And I'm not going to go over in detail deferred tax assets and permanent differences because you've already had that conversation in your previous class. But if you'd like some more clarity, just ask about it in class.